Preparing for a financial analyst at Sempra interview? You've reached Candy Mentor, and this video is for you. We'll walk through 25 key questions you're likely to face. For each question you'll see a sample answer followed by the key points to cover. Subscribe, like, and share, and drop a topic request in the comments. Question 1. Why do you want to work as a financial analyst at Sempra? I am attracted to Sempra because its businesses combine essential infrastructure with significant financial complexity. A financial analyst can evaluate regulated rate base investment, operating performance, project returns, commodity exposure, and funding needs. I also value the company's role in energy reliability and the transition toward lower carbon infrastructure. My strengths in financial modeling, variance analysis, and communicating conclusions would let me support decisions that affect both near-term results and long-duration capital projects. While answering, connect your analytical skills to Sempra's energy infrastructure businesses, regulated utility model, capital investment requirements, energy transition strategy, and emphasis on reliability, safety, and long-term stakeholder value. Question 2. What do you know about Sempra's business segments? Sempra operates across energy infrastructure, with major activities including regulated utilities and infrastructure development. The regulated businesses generally earn returns through approved rate structures and invested rate base, creating relatively predictable earnings but requiring regulatory execution. Infrastructure activities can involve LNG, renewables, transmission, storage, and other projects, which introduce development, construction, market, and commodity risks. I would analyze each segment using its specific revenue drivers, cost structure, capital needs, and risk profile. Make sure to cover Sempra's regulated utilities, infrastructure development activities, geographic exposure, differences between predictable rate-based earnings and project or commodity risk, and why segment knowledge matters for forecasting. Question 3. Walk me through the 3 financial statements and how they connect. The income statement shows revenue, expenses, and net income over a period. Net income flows into retained earnings on the balance sheet and begins the cash flow statement. The cash flow statement adjusts net income for non-cash items and working capital changes, then adds investing and financing activity. For example, capital expenditures reduce cash and increase property, plant, and equipment, while debt issuance increases cash and liabilities. The balance sheet must always balance. In your answer, explain the income statement, balance sheet, and cash flow statement, then demonstrate the links through net income, working capital, depreciation, capital expenditures, debt, and retained earnings. Question 4. How would you build a financial forecast for a utility business? I would begin with operating drivers such as customers, usage, weather, energy prices, and approved rate changes. Then I would forecast rate base using beginning assets, capital expenditures, depreciation, and retirements. I would model operating expenses separately, including labor, maintenance, fuel, and purchased power, before calculating regulated revenue and earnings. Finally, I would link the forecast to cash flow and financing needs, using scenarios for rate case outcomes, demand, and construction timing. Be sure to mention customer demand, rate cases, rate base, allowed returns, operating expenses, depreciation, capital expenditures, financing assumptions, regulatory lag, and scenario analysis around weather and policy changes. Question 5. What is rate base, and why is it important for Sempra's regulated utilities? Rate base is the regulated asset investment on which a utility is allowed to earn an approved return. It typically grows through prudent capital expenditures and declines through depreciation, retirements, or disallowances. Regulators use rate base, operating costs, taxes, and the allowed return to determine revenue requirements. For Sempra's utilities, understanding rate base helps explain earnings growth, capital intensity, customer rates, and why project timing and regulatory approval are financially important. Focus on the definition of rate base, approved investment, depreciation, allowed return, revenue requirements, regulatory approval, and the distinction between earning a return on assets and simply increasing spending. Question 6. How would you analyze a variance between actual and budgeted results? I would first quantify the variance and assess whether it is material. Next, I would separate timing, volume, price, mix, foreign exchange, and one-time effects. For a utility, I might distinguish weather-driven demand from labor costs or regulatory timing. I would validate the explanation with operating owners, determine whether the variance is recurring, update the forecast if necessary, and present a concise bridge showing the cause, financial impact, and recommended action. Make sure to cover materiality, price volume mix analysis, timing, controllable versus uncontrollable drivers, recurring versus one-time items, management communication, and corrective actions rather than merely describing the variance. Question 7. How do the income statement, balance sheet, and cash flow statement differ for a capital-intensive company? A capital-intensive company usually carries significant property, plant, and equipment and records substantial depreciation over time. Depreciation reduces accounting earnings but does not use current period cash, while ongoing capital expenditures consume cash and increase assets. The company may therefore report stable earnings while requiring meaningful debt or equity financing. I would analyze all three statements together, focusing on cash available after capital investment, leverage, interest coverage, and whether growth projects generate adequate returns. In your answer, discuss high depreciation, substantial property and equipment, recurring capital expenditures, financing requirements, working capital, non-cash charges, and why accounting earnings may differ from cash generation. Question 8. Explain free cash flow and how you would calculate it for Sempra. Free cash flow is generally operating cash flow less capital expenditures. I would start with cash generated from operations, including earnings, depreciation, working capital movements, and regulatory-related cash effects, then subtract maintenance and growth capital spending. For Sempra, free cash flow can be temporarily pressured by major infrastructure construction even when long-term project economics are attractive. I would therefore separate recurring maintenance investment from growth projects and assess funding, timing, and expected future cash generation. Be sure to define operating cash flow less capital expenditures, distinguish maintenance from growth spending, discuss project funding and financing cash flows, and explain why free cash flow may fluctuate during major construction periods. Question 9. How would rising interest rates affect Sempra? Rising rates can increase interest expense on floating rate debt and raise refinancing costs when existing debt matures. They also increase the discount rate used in valuation, potentially reducing project values and making new developments harder to approve. For regulated utilities, some financing costs may eventually be reflected in customer rates, but recovery can involve timing and regulatory risk. I would review maturity schedules, fixed versus floating exposure, liquidity, project returns, and sensitivity cases. Discuss higher interest expense, refinancing risk, valuation pressure, weighted average cost of capital, project economics, customer affordability, regulatory recovery, and the importance of debt maturity and hedging analysis. Question 10. What financial metrics would you monitor for Sempra? I would monitor adjusted earnings growth, operating cash flow, capital expenditures, free cash flow, net debt, leverage, and interest coverage. For regulated utilities, rate base growth, allowed returns, customer counts, usage, reliability, and regulatory outcomes are important. For infrastructure projects, I would track construction progress, contracted capacity, operating availability, project costs, committed capital, and expected returns. The right dashboard should combine financial results with operational drivers so emerging issues are visible early. In your answer, include earnings growth, operating cash flow, capital expenditures, free cash flow, leverage, interest coverage, rate base growth, project returns, customer metrics, and segment-specific performance indicators. Question 11. How would you evaluate a new energy infrastructure project? I would build a project model beginning with construction spending, operating costs, useful life, taxes, financing, and revenue assumptions. I would distinguish contracted cash flows from merchant exposure and calculate NPV, IRR, payback, and coverage ratios. Then I would test delays, cost overruns, lower utilization, weaker prices, and higher financing costs. I would also assess permits, counterparties, regulatory requirements, and strategic fit, because an attractive base case may not compensate for severe execution risk. Focus on forecast cash flows, construction costs, operating assumptions, contracted versus merchant revenue, NPV, IRR, payback, financing, downside cases, regulatory approvals, execution risk, and strategic fit. Question 12. What is the difference between NPV and IRR? NPV measures the present value of expected cash inflows less investment, discounted at the required return. A positive NPV indicates value creation at that hurdle rate. IRR is the discount rate that makes NPV equal 0, so it expresses project return as a percentage. I prefer NPV for comparing value creation because IRR can mislead when projects differ in scale or have unconventional cash flows. I would use both alongside strategic and risk analysis. Make sure to explain NPV as value created at a required return, IRR as the discount rate producing 0 NPV, reinvestment assumptions, multiple cash flow limitations, and why both metrics are useful together. Question 13. How would you model depreciation and capital expenditures? I would create a roll forward beginning with existing gross property, plant, and equipment, then add capital expenditures based on expected in-service dates and subtract retirements. Depreciation would be calculated using asset-specific useful lives and the applicable accounting or regulatory method. I would link depreciation to the income statement, accumulated depreciation on the balance sheet, and the non-cash adjustment in operating cash flow. For regulated assets, the schedule also supports rate base and revenue forecasts. Discuss asset additions, useful lives, in-service dates, straight-line or approved methods, retirements, depreciation expense, cash versus non-cash effects, and links to rate base and deferred taxes. Question 14. How would you assess Sempra's debt capacity? I would assess net debt to EBITDA, funds from operations to debt, interest coverage, liquidity, committed capital, and upcoming maturities. I would also examine the stability of regulated cash flows, project-level financing, credit ratings, covenants, and access to capital markets. Scenario analysis would show how delays, cost overruns, higher rates, or weaker infrastructure cash flows affect coverage. Debt capacity is not simply the maximum borrowing available, it should preserve flexibility and support investment-grade financial resilience. Be sure to mention leverage ratios, interest coverage, cash flow stability, debt maturities, liquidity, credit ratings, capital requirements, regulatory considerations, and the effect of project commitments on future borrowing. Question 15. What is working capital, and what would you investigate if it changed unexpectedly? Working capital reflects short-term operating assets and liabilities, such as receivables, inventory, payables, and accrued expenses. If it changes unexpectedly, I would compare the movement with prior periods and budget, then investigate billing collections, payment timing, fuel or inventory balances, construction accruals, and regulatory accounts. I would distinguish a temporary timing effect from a structural change in cash conversion. Finally, I would confirm the accounting data with business owners before revising the forecast. In your answer, define operating current assets minus operating current liabilities, then investigate receivables, payables, inventory, accrued costs, regulatory balances, seasonality, timing, and potential data errors. Question 16. How would weather affect financial forecasting for a utility? Weather can materially affect electricity and natural gas demand, especially during unusually hot or cold periods. I would use historical weather normalized relationships between degree days, customer usage, revenue, and variable costs. I would model regional differences and consider whether regulatory mechanisms offset portions of the impact. Extreme events could also increase restoration or maintenance costs. I would present a base case plus upside and downside weather scenarios, clearly separating temporary volatility from durable demand changes. Discuss heating and cooling demand, historical normalization, regional differences, regulatory treatment, customer usage, extreme weather costs, scenario ranges, and separating operational volatility from long-term structural trends. Question 17. How would you analyze commodity price risk in an energy business? I would first identify the physical exposure by commodity, volume, location, and timing. Then I would separate contracted, hedged, pass-through, and merchant positions. A price change may affect reported revenue without materially changing margin if costs are recovered, while unhedged positions create direct earnings risk. I would test price sensitivities, basis differences, counterparty exposure, collateral requirements, and liquidity. The conclusion should explain both the accounting impact and the underlying economic exposure. Focus on exposure identification, physical volumes, contracted versus merchant positions, hedging, pass-through mechanisms, basis risk, liquidity, sensitivity analysis, and distinguishing revenue effects from margin effects. Question 18. What is regulatory lag, and why does it matter? Regulatory lag is the period between a utility incurring costs or making investment and receiving updated customer rates that recover those amounts. During that period, earnings and cash flow can be pressured, particularly when construction, inflation, or interest costs rise quickly. I would examine rate case timing, interim mechanisms, authorized recovery, and the likelihood of disallowance. In forecasting, regulatory lag should be modeled explicitly rather than assuming every investment immediately produces the approved return. Be sure to explain the delay between investment or cost increases and rate recovery, effects on earnings and cash flow, construction timing, rate cases, regulatory mechanisms, and how analysts incorporate the risk. Question 19. Describe a financial model you have built or would build for Sempra. I would build an integrated project model for a new energy infrastructure investment. It would include construction spending, financing, operating volumes, contracted pricing, expenses, taxes, depreciation, cash flow, and returns. I would add cases for delayed completion, cost overruns, lower utilization, and higher rates, with checks linking the statements and sources documented. The output would show NPV, IRR, coverage, funding needs, and break-even assumptions, allowing management to decide whether the project merits approval. Mention model purpose, assumptions, operating drivers, integrated statements, checks, scenario analysis, documentation, sensitivity testing, and how the model would support a specific management decision. Question 20. How do you ensure accuracy in Excel or financial reporting? I begin by confirming source data, definitions, period alignment, and units. I use consistent formulas, separate inputs from calculations, and include checks for balance sheet balance, cash roll forward, debt movements, and unusual variances. I compare outputs with prior periods and independent expectations, then trace unexpected results to the source. I document assumptions, maintain version control, and ask for a peer review before distribution. Accuracy comes from disciplined process, not just spreadsheet skill. In your answer, cover source verification, consistent formulas, independent checks, balance tests, reasonableness review, version control, documentation, peer review, and investigating unusual results before distribution. Question 21. Tell me about a time you explained complex financial information to a non-finance stakeholder. In one analysis, an operating manager wanted to understand why expenses exceeded budget. Rather than present accounting categories, I created a simple bridge separating volume, labor rates, timing, and one-time maintenance. I explained each driver in operational terms, highlighted which items were controllable, and confirmed the assumptions with the manager. That discussion identified a timing issue rather than a permanent cost problem and improved the next forecast. I learned that clarity matters more than technical complexity. Focus on audience adaptation, simplifying technical concepts, using a clear visual or bridge, emphasizing business implications, confirming understanding, and demonstrating how communication influenced a decision or action. Question 22. How would you prioritize multiple urgent requests from senior stakeholders? I would quickly clarify each request's decision, deadline, materiality, and dependencies. I would prioritize work tied to external reporting, safety, liquidity, or an immediate management decision, while communicating realistic delivery times for lower priority items. If information is incomplete, I would provide a clearly labeled preliminary view and identify what remains outstanding. I would maintain a task tracker, escalate genuine conflicts early, and avoid sacrificing critical accuracy for an artificial deadline. Be sure to mention business impact, deadlines, decision dependency, data availability, clarification of scope, transparent communication, interim outputs, and maintaining quality despite competing priorities. Question 23. How would you evaluate a budget request for additional capital spending? I would first determine whether the spending is required for safety, reliability, compliance, maintenance, or growth. Then I would test the scope, cost estimate, schedule, alternatives, expected benefits, and regulatory recovery. For discretionary growth investment, I would calculate NPV, IRR, payback, and sensitivity to utilization and delays. I would also assess funding and balance sheet impact. After approval, I would compare actual cost, timing, and benefits against the original case to improve accountability. Discuss strategic need, safety and reliability, regulatory requirements, scope, cost estimates, timing, benefits, alternatives, NPV, risk contingencies, funding impact, and post-investment performance measurement. Question 24. What accounting issues are important for a regulated utility? Important areas include regulatory assets and liabilities, revenue recognition, depreciation, deferred taxes, asset retirement obligations, impairment, and capitalization policy. Regulatory accounting can defer certain costs or benefits when recovery or refund through future rates is probable, but recoverability must be assessed carefully. I would understand both the accounting treatment and the underlying regulatory order, then evaluate whether balances remain supported. These judgments can materially affect earnings, cash flow presentation, and future customer rates. In your answer, cover regulatory assets and liabilities, recoverability, depreciation, asset retirement obligations, deferred taxes, revenue recognition, impairment, and differences between regulatory accounting and general-purpose accounting. Question 25. What questions would you ask your interviewer at the end of a Sempra Financial Analyst interview? I would ask which decisions this role supports most directly, how the team measures analytical quality, and which operating drivers currently create the greatest forecasting uncertainty. I would also ask how finance partners with utility, infrastructure, regulatory, and project teams, and what a successful first year would look like. Finally, I would be interested in the development path, the systems used for planning and reporting, and the qualities that distinguish high-performing analysts at Sempra. Make sure to ask about team priorities, analytical responsibilities, key performance measures, current business challenges, collaboration with operations and regulatory teams, development opportunities, and what success looks like in the first year. If you are still with us, congratulations, you are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.